There we go. Okay, so welcome to our webinar. Thank you for taking time out of your busy schedule to be on this webinar today. We do really appreciate your support and interest. Just a show of hands quickly, if you can just select your in the hands box in the bar on the side. How many of you are hedging your bets? Okay, and I'll explain now what I mean by that. When I say hedging your bets, okay, so there's only one or two. Some people are confused. Okay, yeah, I expected them to be confused by that question. What I mean by that is, when I say hedging is betting on both sides of an event. Okay, so let's talk about the market. Hedging both sides of the market to ensure you make a profit regardless of the outcome. So now, based on that definition, how many of you are hedging your bets? Okay, not many people, one or two. Okay. Okay, well, this is the reason why we're having this webinar today. So a lot of you are a bit confused. Okay, we'll go into it now in more detail. Great. Okay. So, and you can see the subtitle there is, do you fully appreciate the value of preparation? And here's a quote from Albert Hubbard. The best preparation for good work tomorrow is to do good work today. In other words, obviously being prepared on the market. That's number one. And number two, here's a quote from Colin Powell. There is no secret to success. It's a result of preparation, hard work, and learning from failure. So going on what I said last week when we spoke about currency futures, is put your feet in the in the water and slowly start trading. The same thing what we will talk about today. So my objective of this webinar, the results I want for you after, or the outcome I want you after this webinar, is to create awareness like we do with every webinar, but for you to take advantage of the volatility on the market, to do something about it, to plan for it, and hopefully, you know, after today's presentation, you'll be a bit more prepared, so you can make better informed decisions. And ultimately, always I say your ultimate objective is to have peace of mind. Okay. So talking about preparation, here's a quote, and I got this quote from a book called Hedge Fund Market Wizards. It's sold Jack Swagger. If you don't understand why you are in a trade, you won't understand when it is the right time to sell, which means you will only sell when the price action scares you. Most of the time when price action scares you, it is buying opportunity, not a sell indicator. And you know, you'll see within the presentation, especially the front part, we talk about now the current situation. I think a lot of you are aware of what's been happening on the markets and things like that. And I can use an analogy of the weather we've recently had here in Gauteng. Dark and gloomy, overcast, miserable, wet, and cold weather. We mean it's snowed down in Lesotho and the Free State and things like that. But unlike that kind of weather where it eventually blows away today, we've got sunshine. There are dark clouds appearing on the markets. Why do I say that? So we can look at two scenarios. First of all, the current situation in South Africa, just this past week alone, rating agencies left South Africa just a notch above junk status. There's a very broad consensus that we might have a downgrade here by December. We've got a lot of work to do, and I spoke about this in last week's presentation. But also during this week now, our GDP figures came out. Our gross domestic data came out negative for the first quarter. So we're halfway through into what they call a technical recession. So that's not good. So things are tough out there. You know, we in the environment we have rising inflation, rising interest rates, and at best zero real growth. So that's just looking at South Africa. And yes, there's a lot of policies. We spoke about it last week with the political scenario, etc. But looking at global picture, and just today, there's concern ahead of the Federal Reserve's interest rate decision today. Okay, there's a lot of, when we talk about volatility, that's created by uncertainty, and there's obviously all these things that are affecting that kind of sentiment. Also, this last week, we saw the World Bank revise downwards the expected global growth. Okay, so things are not looking good out there. Trade prospects for China remain poor. And then next week, and this is also, I was watching CNBC this morning, the referendum next week, when we talk about Brexit, Britain's exit out of the EU. Next week, 23rd, next week, Thursday, they are voting. And I just read a very interesting article in this week's Fin Week about this whole Brexit and the repercussions and what if scenarios. Obviously, it's going to create a lot of chaos. There's great expectation that the rand will, not the rand, the pound will devalue or weaken. But you can understand that the euro and the pound, there'd be a lot of volatility around that. This whole article says there's a 60% chance, 60% chance that Britain will leave the EU. And the whole thing is obviously trade. They anticipate that trade will be better. But it's also a lot around the migrants, where they feel that they'll have more control. But bottom line, we're talking about GDP will fall. This is in the UK's GDP will fall. There will be a big impact on the labour market. There will be the weakening of the pound, and all those kind of things. So obviously, a lot of our dual-listed companies, they feel that British American Tobacco will be hit, Capco will be hit. Where else? It was just Richmond. I think those are some of the companies I realized I read about in the article. But get hold of the latest Fin Week. Good little article on Brexit, gives you more insight into it. But what about the big investors, the billionaire investors? What are they doing? And this is just a snippet I got from one of my newsletters. Billionaire hedge fund investor, hedge fund founder George Soros is betting on a big stock market collapse this year. Okay. Some of you might have heard of the billionaire activist investor Carl Icahn. Okay, he's increased with his hedge fund. He's increased his net exposure from a net 25% short position to a net 149% short position. Okay, and then some of you might have heard of a guy called he's a famed trader, Stanley Druckenmiller. He's warning that he sees a worse crisis than the 2008 ruin. And Bond King Bill Gross is calling for tougher times ahead for investors that will bring high volatility and lower returns. Okay, he believes a short of a lifetime is directly ahead. And we'll talk about some of this terminology just now. We'll talk about shorts and that. And then lastly, international investor Jim Rogers has also warned that the next bear market is going to be worse than those most of us have experienced. Now that's all scary stuff. Now these are big billionaire, most of them are hedge fund managers and things like that, but they're positioning themselves and they're preparing themselves for a market collapse. Okay, so what are you doing about it? So the main idea is for you to take advantage of it. Be prepared, take advantage of it. So what's our ideal situation? As I said, you want to have peace of mind. And I always believe that my goal as a trader is to be a consistently profitable trader. What I mean by that is it's a bit of a balancing act. You know, you on the one side, you want to manage the risk. I think it's more important to manage the risk, but also the other side of the coin, obviously you're going to be making profits. So how do you do that? Okay, and today we're going to talk about being either a hedger. We're talking about hedging or being a speculator. And we're talking about the two different approaches now, but we're talking about trading as opposed to investing today. So what are hedges? Hedges basically reduce their risk. The way I look at it, hedges buy insurance. Okay, they are seen as risk averse. They try to reduce risks associated with uncertainty. Basically, they take a offsetting position to balance any gains or losses. Okay, so they eliminate the price volatility. Example, a company that specializes in producing jewelry. Okay, and they've got a major contract coming up in 6 months' time, which gold is one of the company's main inputs, gold bullion. So the company is worried about the volatility in the gold market and believes that the gold price may increase substantially in the near future. So in order to protect themselves from uncertainty, the company would then go and buy a 6-month futures contract in gold. This way, if the gold price suddenly increases by 10%, okay, the futures contract will lock in the price and offset those gains. So you can see that ideal hedge causes one effect to cancel out another. So that's neutral. That's the ideal hedge. But bottom line, as a hedger, you're trying to protect against any losses. Okay, but also understand that you're restricted from any gains. So it's like a zero sum. You call it a zero sum. That's what some of you will be hedgers. You might have a share portfolio. We'll talk about this in more in next week's webinar. We're talking more about single stock futures on individual stocks. You might have a share portfolio and you want to hedge yourself against the market falls. So what you lose on the share portfolio, you make up on the single stocks. Okay, so that's to be a neutral situation there. So that's the hedgers. What about the speculators? Now, the speculators are those that are betting on where the market's heading. In other words, they want to profit from betting on market direction. So understand that you're vulnerable to both the upside and the downside because it's out of your control. You don't know which way the market's going. Yes, there's ways and means of betting the odds in your favor, but just understand that speculating is obviously a bit more risky. And we'll talk about risk management just now. But speculators are basically seen as risk lovers. Okay, so where do you see yourself? Excuse me, are you a hedger or a speculator? I'm both, depends on the situation, depends what I want to do. Okay, so how do we get there? So what am I proposing today? How do we do it? And today's presentation is good. We're going to talk about trading index futures. So we're talking about trading, as I always trading the big picture, the big guns. We're trading the JSE. We're trading the top 40 stocks on the JSE. So it's like saying, okay, what's happening with South Africa's stock exchange? And I'm trading that market. So that's what we're talking about. So futures contract, first of all, remember the index future we're talking about is based on the top 40 index. However, the futures do trade at a slight premium. Sometimes you must understand a big order can distort that picture also. There's more buyers and sellers might be on both sides, might be moving the market, and hence that premium. But index futures are very, very popular with the traders. Number one, because of liquidity. Number two, it's cheap, very low trading costs. And number three, very tight spreads. So the difference between the buyers and the sellers, the bids and offers, are very, very narrow. So those are the things that attract people to index futures, trading index futures. But before we get into the nitty-gritties, let's just talk. I know some of you might be new to the market, so let's talk about the terminology. So first of all, understand that we're talking about derivatives. We're deriving our value on an underlying index. In our situation here, we're talking about the top 40 large cap index. The top 40 large cap stocks, the size of the companies on the JSE, we're trading that as a basket. So we're trading the index. So understand also that it's a geared product. I'm putting down a deposit. If I'm putting down roughly about 10% and I've got 100% exposure, my gearing, my leverage is 10 times. So if the share moves 1 rand, my underlying moves 10 rand. That's the gearing. So we talk about opening a position. We talk about opening a long position. This is where you're going to take advantage of rising prices. In other words, you're going to buy. And we talk about opening a short position. So I buy something at, I've used the example always, it's simplified. I buy something at 5 rand and I sell it 10 rand. I made 5 rand profit. That's what we call a long position. A short position, I sell at 10 rand and I buy back at 5 rand to take advantage of falling prices. So the thing is, doesn't matter what's happening on the market, there's always opportunities to trade and hopefully to make profits. Now, to do the opposite, we want to close out a position. Okay, you do the opposite. So if you're long, you'd sell, and if you're short, you'd be buying back the contract. Remember that buying at 5 rand and sell at 10, and sell at 10 and buy back at 5. That's what I was explaining there. So let's go into the details of what is a contract and things like that. So we talk about initial margin. Another way of looking at it, it's a minimum deposit or the initial deposit you need to put down as a trader to be able to open up a position to go long or short. That's number one. Now that money gets ring fenced. In other words, you have to keep it at that margin, that deposit on a daily basis. So talk about the position being marked to market. So on a daily basis, we have what they call a daily revaluation of each open position by the exchange at the close of each business day. Now you can see right at the bottom here, remember futures trading hours are slightly different. We open at 8 and we close at 5. So just be aware of that scenario. Remember the JSE opens at 9 o'clock and closes at 5. So we've got extra hour on the futures market. So remember I said that initial margin gets ring fenced. You need to keep that initial margin on a daily basis. If you bought something at 5 rand, instead of going up, it drops. drops to 4 Rand, that 1 Rand you need to top up. So that's what we call variation margin. Now that variation margin is a daily process through which the unrealized profits and losses are processed on your account, so the cash should be taken out of your account if it's a loss. If it's a profit, on a daily basis, that money be deposited into your account. In other words, you can use that additional funds, additional money to take out more positions if you want to. We're talking about futures today. Futures have a life, there's expiry. So with index futures, they are closed out at the end of the contract period. Now, futures closeout would have happened on the third Thursday of every quarter. We're talking about March, June, September, and December. So that would have been tomorrow. But because of tomorrow being a public holiday, we actually had the futures closeout today. The JSE SAFEX had the futures closeout today. However, at PSG, we always roll a week before. So we actually rolled over the contracts last week, Wednesday. But remember, with index futures, they don't get it rolled over. They'll actually closed out. Okay. So let's get into the nitty-gritties. Right now, the index, the All Z, we'll talk about it now. I mean the All Z. The initial margin required for the September contract, we're trading the September contracts at the moment, is 32,460. So remember, this margin is decided by the JSE. So first of all, I'm putting down 32,460 Rand to have 10 times exposure to the market. So let's say if the market is trading at 40,000, my exposure is 400,000. So I'm putting down roughly about, or putting down 32,000 Rand to have that position open. So first of all, very capital efficient. Secondly, very low trading costs. It's going to cost you 25 Rand per contract to open up the contract, and another 25 Rand to close it. Those are two different transactions. So very low trading costs, they're cheap. Every point the market moves, so we talk about an index point, is worth 10 Rand. So for example, if the market moves 100 points, it's the equivalent of 1,000 Rand profit and loss. I suggest you try and go for 105 points because you want to bring in the costs. Remember, it's 25 in, 25 out, it'd be your 50 Rand, which is your 5 points there. Okay. As I said, remember these things, the index futures do expire. There's no rollover. They actually physically closed out. Okay, so if you wanted to trade a week ago, we'd have given you the two options, a June contract and a September contract, as well as also the December contract if you wanted to. Just understand, obviously, it might be slightly bit higher because interest is included in the price already. So the Aussie is giving exposure to 10% of the market. But let's look at two little examples of how the index future would work. So let's take an example. This is until yesterday. This is looking at the JSE All Share 40. Remember, it's loosely based on that. So I'm anticipating the market to fall as below its moving averages. This was Monday's closing price. So obviously I haven't updated for yesterday yet. But let's anticipate. You can see the last few days we've had negative candles, bearish candles, but it closed below that 50-day moving average. It's still trading above a 200-day, but we're anticipating to break through the support trend line soon. So there's the index future at the moment, also in here. So there we go. See how it's been anticipating the movement down. So let's anticipate that we have gone short. That's one scenario. But so anticipate the market to go short, but imagine if you had bought way back here again and the market ran up. So those are the two scenarios. So open trade, I want to talk about this first column here. So I'll bring in my spotlight first. So my first trade on open, I want to go long. How many contracts? I'm going to buy one contract. In other words, each point is worth 10 Rand. This is the index value when I actually put on the trade, 46,100 points. Okay, my initial margin was 32,460, which we discussed already. So that there, my index value times 10. So remember we're trading times 10. So it's roughly about 461,000 Rand would have been my exposure. It's going to cost me 25 Rand. So that's putting on the trade. That's opening the position. Down the line, I want to close now because the markets went up slightly. So I close out. So there I bought, there I sell. So the market's moved up to 46,364 points. It's going to again cost me 25 Rand to close out the trade. The difference between buying and selling was 264 points times 10 Rand a point was 2,640 less my costs. So there we go, 2,519 divided by my initial margin, the money I put down. So this scenario, and this can be a day trade. One trade would have given me a return of 7.98%. Okay. The opposite now is the short. So yeah, I'm taking three contracts. So each point is equivalent to 30 Rand a point. So yeah, I'm buying slightly bit higher, and anticipating a falling market. So there I'm also putting 3 times margin down. So 3 times that, that's how I got my 97, and that times 3, that's my exposure. My 25 Rand times 3 contracts, or 75 Rand, and there I close out. There's my transaction cost in this scenario, 810 points, and make 24%. If you look at that scenario, taking advantage of falling prices. So that made a bit of sense to you guys. As I say, it's not for everybody. You know, the margin is a lot, and we'll answer that in the next slide. So how much would you need? There's a smaller stepping stone. This is a mini version of the Aussie. It's called the All Me. So it gives you 10% of the Aussie. So liquidity and spreads are improving as more and more people, as more and more people get into the trade. There is a market maker. So your people from Macquarie and Rand Merchant Bank making the market. Their goal is to ensure liquidity, number one. So there's always a willing buyer and a seller, but also help you track. It helps facilitate that the index tracks the Aussie. In this scenario, each point is worth 1 Rand. You can also see that the margin is only a tenth of the Aussie, so 3,246 Rand. Your cost is only 25 Rand. Remember, compared to single stock futures, there's no booking fee. Okay, and again, remember, there's no expiry. So let's look at a practical example. Again, one contract, same scenario. I use the same numbers just to show you that exactly the same scenario. One contract, there's my margin, there's my costs. Same scenario. Yes, I'm only making 254 Rand, but as a percentage, 783. Okay, but you do that 2 or 3, 4 times a day, yeah, that's not bad. I'm going short, exactly the same scenario. I'm going 5 contracts now. There's my exposure, there's the margin, and you can see in that scenario. As I say, when you get this presentation, review it. It'll make a bit more sense to you. Okay, so what are the benefits? Okay, we've spoken already about being capital efficient. We've already spoken about low trading costs and obviously tight spreads. But there's other benefits. Now, you gain exposure to a basket of stocks. Now, to the top 40 stocks without purchasing the shares directly. So it's through one index or through one future, you're betting on the top large cap stocks on the market. What's nice about it is also it provides the advantage of volatility trading. And if you're a trader, you love volatility. But also what's nice here is that you profit proportionally the volatility in the market. Now, yesterday I saw that the market yo-yoed up and down. You'll see on the next slide when I took a screenshot. We're talking about 700 points. Now, that's just, if you got it right in the beginning of the morning, the market fell. That would have been 7,000 Rand just on the Aussie for doing nothing yesterday, if you just had a short position. What's nice about it is hey, you can take advantage of declining markets. You achieve leverage positions and you can hedge a physical position. So you might have some questions, but before that, let me anticipate some of those questions. What trading style would suit me to trade index futures? Now I believe that most of us do not have the time to be sitting in front of the computer and be trading the index futures all the time, because it is, I believe, very time intensive. But index futures are great for day trading, short term. A pure day trader would not hold a position overnight. That's a pure day trader. You'll grab trades intraday 2 or 3 times a day, and some of you might go for just one long trade. That's fine. But as long as you grab more than your 105 points, that's great. 100 points a day, that's what you're looking for. Most of you will be falling to what we call swing trading. It's also a short-term time period. We're talking from 2 days to a few weeks. Okay, so that's where a lot of you will be using more the technical analysis, and especially with day trading. Yes, if you're watching live prices and things like that, but you want to take movements within the market, take advantage of that. I use breakout trading. I still use my support and resistance trend lines, moving averages, all that kind of stuff intraday. But and we'll talk about what software we use for that. Swing trading, you can still use your intraday data to make the decision, and then place your trades intraday, and then watch it from there. Position trading, I believe it's more suitable for things like CFDs, more, as I say, longer term, months to years. The guys there use the weekly and monthly charts. That's more fundamentals and technicals together. But in today's context, we're talking about day trading. So most of you will be doing swing trading, and once in a while do a day trade when there's opportunity. So that's where it fits in. Last week we spoke about currency futures, the same thing here. Remember with currency futures, last week I said if it's a day trade, the JSE actually tries to encourage you to do day trading. The cost is halved. Okay, index futures, 35 in, 25 out, but still very cheap. Okay, what do you need, okay, to be a day trader? What do you need to select your trading style? So first of all, it depends on your trading account size. You saw just now, just to have the Aussie future, you need 32,000. Just for initial margin. I believe you need much more than that to obviously cover the variation margin and the daily drawdowns and things like that. 100,000 at least gives you that flexibility to trade one contract. Some of you might go 2 contracts, but just understand obviously higher gearing. Your trading style will be dictated by the amount of time that you can dedicate to trading. As I say, most of you have full-time jobs, won't have the time to sit in front of the computers, so swing trading is fine. When you're a complete novice, I sincerely recommend you stay away from index futures and derivatives at such time you understand how the market works, sort of equity futures. So you do need a level of trading experience. So start with the All Me. One look contract, 3,246 Rand. And then watch it from there, understand how the market works, understand how the platform works and things like that. So it also depends on your personality. You need to be a bit of a risk taker. So it comes back to your risk tolerance and things like that. Okay, so those are the things you need to take in consideration. And then what I believe as a trader for index futures, you really do need technical analysis software. This is a screenshot I took yesterday. This was my little trade on the Aussie yesterday. So we use a third-party software program called Swordfish. It's from a company called Estuary. So if you do open up a single stock futures account with PSG, you automatically will have, well, not automatically, but you can download the Swordfish. It's all on the website, and there's online videos that on Estuary's website that'll help you how to use it and things like that. What I like about this, you can set it up for tick by tick, minute by minute, whatever kind of charts. This is only one of my charts that I've made the screen bigger. What's also I like about it is you've got a trading platform. I can trade from the charts. Okay, I can trade from the charts, and I also can put my stop loss in place here. Okay, so it's a very useful tool to use, and I know many of you guys do use Swordfish. Okay, so I hope you guys enjoyed it. Let's see what kind of questions you guys have. Just before I do that, let's just quickly look at a quote from William O'Neill. In bear markets, stocks usually open strong and close weak. And bull markets, they tend to open weak and close strong. You can relate that back to candlestick charts, and that's the sentiment behind it. But just as a sideline, I thought that might be interesting to take in consideration. So let me see what kind of questions you guys have. Okay. Cool. Okay, sorry, let me just grab his questions here. Okay. So a lot of people give me a response to about the quotes, about the sound. Okay. A corner, I'm not 100% sure. Cost is 5 Rand, not 25 as you said. It's 5 Rand for the All Me contract and 25 for the All Z. So it depends which contract you want to trade there. Siva, regarding tax implications, this is income tax. So if you're on a trade, just be aware that obviously you take in consideration the cost, number one, and number two, any profit you make, you declare it, add onto your income tax in the year. Receiver says this is all trading, it's income tax. Okay. Schools, when's my next CFD seminar, webinar? To be well, a few weeks time, 3 months time. I don't know when I'm going to do one again. Next week, we're talking about single stock futures. So unfortunately, it's very similar, but I haven't got a set date yet for CFDs yet. Alan, a good question here. With leveraging, what stops you from taking a one long and one short trade and then pocketing the difference every day? It's not, you basically trading a zero position there. What's better to do there is to do what they call pair trading, especially on the single stock future side. You might want to go long, for example, Telkom, and short MTN. They're the same industry. So there's a bit of correlation there. You might want to go long Anglos and short Billitons. So that's what the little guys do. Okay. But to open up a long position and a short position on the Aussie, what you lose on the swings, you make up in the roundabout. So it equals out. So, Ellen, I hope that makes sense to you. Can you do all this on PSG Online? Yes. Okay. Milan, yes. No problem. I'm not 100% sure if Swordfish is available for a Mac. Best thing to do is, I say, it's third party. By the way, if I go back to that slide, just go up again, page up, page up. Right at the bottom here, you guys can see below the chart is a link to the page where you can find more information on it. Okay, so okay, so I hope that answers your question. So I'm not 100% sure if it'll work on Mac, but I think that should be. I see that they do have, I think they do have it for Apple, the Apple iPhone. So I presume if they've got it for iPhone, they might have it for the Mac. Okay. Corner, no problem. Obviously, I must probably say something wrong there. Okay. Is your loss then multiplied by the leverage? Okay, whatever your loss is in points times 10. So that is your loss. Remember the leverage. Yeah, I think that's what you mean by that. So if your market goes against you 200 points times 10 rand, you've lost 2,000 rand times 10. So that's where the gearing comes in. So Alan, I hope that makes sense to you. Okay. Are there any other questions? Okay, looks like that's most of the questions. Yes, thanks. Pity. Alan, yes, that's what you call derivatives. There's losses involved is managing those risks. So stop loss is very, very important. Milan, I'll have to answer that question of yours offline. Jeff, what is the all me? It's 10% of the all me. So it's a smaller contract. The margin requirement is smaller. The point movement is only 1 rand instead of 10. The margin is only 3,246 rand, 10% of the all Z. So all me is just a smaller contract. So it's a nice little stepping stone. I call it a stepping stone to the big guns. So Jeff, hopefully that answers your question. Okay, guys, look like that's most of the questions. Cool, no problem, Jeff. Okay, let's get into just wrapping this all up. So, in conclusion, what you to walk away with this presentation, understand it's a geared product. So yes, everybody understands the initial deposit, initial margin. The risk comes in by not understanding how the variation margin works. Remember, it's on a daily basis. Profits and losses are put into your account. This is not paper trading. This is real money put into your account. Okay, so remember the benefits are low trading costs, transparent pricing, and obviously tight spreads. Going with a geared product, remember, it's also capital efficient. I'm putting down 3,000 or 32,000 rand to have 400,000 rand exposure. Okay. So thanks, guys, for being on this for this webinar. In conclusion, if you guys are interested in these futures, go click on this link here to take you through to our page on single stock futures. When you register to open up a single stock futures account, automatically we'll have an index futures link to that. If you want more questions answered, you can contact our client service department, and there's the contact numbers. Next week, we got a webinar, as I mentioned just now, on single stock futures. So we're going to talk more about going short and going long on equity single stock futures, and maybe highlight some opportunities there. The week after that, we don't have a webinar. I'm away on leave for 2 weeks, but I'll be putting up the webinars for the next 3 months or so very soon. Okay. So from my side, thank you very much for being on this webinar. There's my contact details. Welcome to drop me email, things like that, and I'll get back to you guys. Okay. So thanks a lot for being on this webinar. Until next week, enjoy the rest of your day. Bye for now.